Hey there. Have you ever heard of bonds and wondered what they actually are? They sound complicated, but they're actually one of the simplest investment concepts. In this video, I'll explain what a bond is, how it works, and how it's different from stocks in just a few minutes. What is a bond? A bond is basically a loan. When you buy a bond, you're lending your money to a company or a government. In return, they promise to pay you back later, plus extra money called interest. Think of it like this. If you lend a friend $100 and they promise to pay you back $110 in 1 year, that extra $10 is the interest. A bond works the same way, just more official and structured. How do bonds work? Every bond has 3 key parts. Principal, the amount you lend. Interest, coupon, the extra money you earn. Maturity date, the date you get your original money back. For example, if you buy a $1,000 bond with 5% interest, you earn $50 per year until the bond matures. When it reaches maturity, you get your $1,000 back. Simple. Bonds versus stocks. So how are bonds different from stocks? When you buy a stock, you own part of a company. If the company grows, you can make a lot of money, but you can also lose money if it performs badly. When you buy a bond, you're not an owner, you're a lender. That means lower risk, more predictable returns, but usually lower profits compared to stocks. Stocks are like riding a roller coaster. Bonds are more like riding a train, slower but steady. Pros and cons. Pros: safer than stocks, especially government bonds. Predictable income. Good for stability. Cons: lower returns. Inflation can reduce your real profit. Less exciting growth potential. So a bond is simply a loan you give to a company or government in exchange for interest. It's not the fastest way to get rich, but it's one of the safest ways to invest. If you want more simple breakdowns of finance topics like this, make sure to like and subscribe. See you in the next video.